Hey, what's going on, everybody? This is Sam Kwok here.
And this is Daniel.
And we are the Kwok Brothers.
And CNBC recently posted an article saying that the housing boom is now officially over.
Yeah.
So congratulations, everyone. We made it.
I guess we're out. Yeah.
I guess we're out. But see, here's the thing. So Sam and I, and we don't pat ourselves on the back too often. So I'll pat his back.
Sure.
So that way I'm not patting my own back. But Sam and I have been saying for months now that you cannot have a sustainable housing market where the asset, the price of the asset, the value of the asset, and also the cost of housing, which is rent, skyrocket like the way that it did. I mean, literally from March of 2020, since the beginning of the pandemic, they said that the median home price jumped up 24%. Yeah. Rent has gone up hundreds of dollars all across. I mean, even in our area, right? It's gone up. You know, my rent's gone up $200.
Yeah,
and I think a 3-bedroom went up 600 literally in the last 12 months.
Yeah.
So, I mean, but we've been saying it. You cannot have that much of an increase in rent and cost of housing when wages and income are not at sustainable levels and they're not increasing. So it just goes to show you that what we have been seeing all this time, though, is actually a bubble on debt and also credit. Mm-hmm. But we'll touch on that a little bit. Yeah. But I mean, Sam, what are your thoughts on all this?
Yeah. So I mean, just looking back, I can see what was really happening, and this is just an hypothesis. But looking at this chart right here, I'm looking at the new listings chart, and this is provided by Reference Data. If you go back to last year, March 2020, you'll notice that there's a major dip on new listings and new inventory in the housing market. And of course, March 2020 was the month where the United States decided to declare a national emergency due to the COVID-19 pandemic. Now, you notice that this past March 2021, we had a sudden spike of new listing compared to last year. Now, compare that to this March of 2021, the trend seems pretty normal compared to what we've seen in 2019 and 2018. So new listings are back to where it is. But my theory is that we had such a large demand even during the COVID-19 pandemic, even through 2020, people still wanted to buy homes and move and displace, but they weren't able to do so because of COVID-19. And this year in 2021, as we're starting to see the recovery, as we're starting to see the vaccination happen, people all of a sudden said, you know what, last year we couldn't buy, this year we're gonna buy it. So I think we almost have kind of a double the amount of demand that we would typically have because again, people were still wanting to buy a home last year, but they weren't able to. People who naturally want to buy a home this year, plus the ones that wanted to buy last year, has now combined to a massive demand. So I think that's one of the big reasons why we did see this huge demand, this uptick of home prices, as well as this frenzy of homes being sold between March through pretty much early June of 2021.
Well, let's think about this too, because we have that, and Sam, you bring up a very good point. But obviously, we can also talk about the low mortgage rates and all the artificial boosts and government intervention that has been happening. So much, right? I mean, the Fed balance sheet is over $8 trillion, and some are speculating that it'll actually go up to 20 because of potentially of a second lockdown. Which, by the way, we released that video this past Monday. Right. But we also haven't talked about the fact that we've been seeing, and I alluded to earlier in this video, a debt and credit bubble the last 12 to 18 months, and really kind of just the last 10 years. Because think about what the Fed, what the government has done in response to the COVID-19 pandemic, is they've given banks, they've given retail investors, the bond market so much leeway and freedom that it has caused a lot of individuals to have credit and debt cycles. Because think about this, when have we ever seen this many diverse offers for one piece of real estate? I mean, I remember 3-4 years ago, everybody was all about FHA, right? Hey, I'm an FHA buyer. I'm going to put my 3.5% down, and I'm going to pay my PMI and all this stuff. But think about the amount of cash buyers that we have today, or we've had the last 12 months, the last 18 months. And if you think about this market cycle, right, it's a hot market. So therefore, somebody sells their property and then they get the cash because, of course, there's debt and there's credit, right? So if there's a loan that they got from a bank or whatever, that gets translated to cash. And now we have a cash buyer re-entering the market because, they need a place to live too. And because there's a cash buyer, it now weeds out all the other competition with loan borrowers, FHA borrowers, thus creating even more competition in the market. And it's just this never-ending cycle. But of course, according to CNBC, this is an ending cycle because, as they say in the article, sales of new single-family homes fell to an annualized rate of 676,000, which is 6.6% below May's rate of 724,000 and 19.4% below June 2020, the level of 839,000. Now, here's what's really interesting. CNBC came out with saying that the median price of a newly built home in June rose just 6% from June 2020. So in my opinion, right, again, like the housing boom, maybe it's over, maybe it's not. I think it's slowed down.
Yeah, I think it's still going. I mean, just looking at the data here, we're still, I mean, you look at the active listing. So we'll go pull up that chart right now. If you look at active listing, we're still at a very relatively low rate. I mean, you compare to 2019, 2020 active listings, we're still in the bottom. Yeah. We were hovering around that 600,000 active listings pretty much the past, 6-7 months. And that's still low compared to what in 2020, in that same amount of period, we were hovering around 800 to 900,000 active listings. And there's two ways to really interpret that is, if we're not seeing as much active listings, first scenario that could be happening is when something hits the market, it's gone right away. Therefore, it takes the home off being active listing and it just goes away and it never shows up in data. That's one hypothetical theory. The second theory is that because we're seeing really low active listing numbers compared to 2019 and 2020, the demand stayed the same, but the supply has dropped considerably. Therefore, there's a natural increase of price. So I don't know if there is this frenzy to buy homes. I think the demand has stayed relatively the same. It's just shortage of supply.
Yep.
A, because people don't want to move due to COVID-19, and B, if they do sell, well, they're going to have to buy a home that has inflated in price.
And if you think about it too, the market was very much self-repeating because those individuals who left the market, who sold their homes, well, they now need a 3 to 4 month lease.
Yes.
To be able to, while they find their next place, right? Or while they find their next home or whatever. And unfortunately, I believe that's what's caused the big rent. Obviously, we've had an affordable housing issue long before the pandemic was even around, right? So if you talk about, introducing individuals who have the money, who have the cash because they recently sold their home, they have the funds to be able to do a 3 to 4 month lease. If you do that throws off the entire curve of individuals who want affordable housing. And that, I believe, is why rents have gone up so much, which, by the way, maybe this is a video topic for another day. And let me know your thoughts in the comments if you want to see this video. But I believe that the rents are not actually going to rise as much as a lot of other economists and media groups think it's going to be. If anything,
and keep in mind, Daniel, that rents are increasing in only certain areas that have a lot of migration coming in, a lot of inbound migration.
Sure, but even like our home state of Illinois, right? Like, I mean, we're number one in people leaving, right? We're right up there with California and New York,
right?
But yet rents have around our area has been going up, and to my knowledge, rents around other areas in the state of Illinois has also been going up. So for me, I just honestly, maybe this is a little bit of a controversial thing to say. Maybe this is going to spark some debate, but I actually think if we're looking at the next 3 to 5 years, I actually believe rent is going to go down. I don't think it's actually going to go up anytime. I think it will maybe for a little bit, but I think once the market faces reality and the housing market adjusts itself, and we don't see a lot of these 3 to 4 month leases that's taking up inventory in the rental space, I think we're going to see rents being pulled back.
I would only partially agree with you, mainly because I do agree that the rents will come down temporarily. I think that's probably more of short term, but I think if we're talking about 3 to 5 years, I think the rents will still continue to go up, mainly from the fact that now we got Gen Z graduating from college, they're entering the workforce. Many of them will have student debt. That won't change, unfortunately, and they're not going to be able to buy houses. So the only way that they're going to be able to live is through renting. We see a lot of roommating situations happen, right? Cohabitating situations. So I think in the next year, I think we're going to see rents drop. We're going to see the rent prices cool down. But if you're really looking out at 3 to 5 years, I think it's still going to be at a steady increase. Nothing like crazy or major increase, but at a still a steady pace of increase.
Yeah, and it'd be really interesting to see. We're definitely going to have to pay attention
data on this.
How much apartment units are being built, because right now it's very competitive. Yeah, unless you're a Class A apartment complex with the amenities, with the pool, the fitness centers. I mean, you're really not going to do much in being able to compete for renters. So, I mean, we are seeing, even in our area of Illinois, where again, we're top 1 and top 2 in people leaving, there's 2,000 apartment units being built, literally 10 minutes parameter or where we are, diameter where we live, where Sam and I live.
Yeah.
So I mean, it's just unreal. So we'll get that data. But in terms of the housing market, going back to what the video is about, I personally think it's slowing down. I don't think we've seen enough data to where say, hey, the housing boom is over. You and I both know that this is not sustainable.
No, and we're not out of the woods yet. I mean, you look at the months of supply, which the data that I have is weeks of supply because I want to see how data moves every week. But we're still, again, at a very low point. If you compare the last 3 years, I got 2019, 2020 data. You notice that the blue line, the red line represents the last 2 years, right? 2019 and 2020. The orange line is the current year, 2021. And again, we're still at a very low weeks of supply compared to the past 2 years. So we're not out of the woods yet. If the demand, again, stays the same, all we're going to do is we're just going to continue seeing the prices go up.
100%.
Now, if the demand stay the same, but the supply goes up, then we're going to see the prices. Yeah, we're going to see the prices cool down. Which, of course, we're paying attention to the eviction moratorium. That's number one, and of course the forbearance program is expiring,
and we're also
September.
We're also paying attention to seeing how mortgage lenders modify the mortgages that are in forbearance. I think that's going to be a huge factor in as well.
Yeah, and we're hearing stories like 40-year, 50-year mortgages, which is insane.
And by the way, you're modifying a previous mortgage in forbearance to a 40 or 50-year, which is, in my opinion, unheard of.
It's insane. So so that being said, guys, we're tracking data, and again, we remind you time and time again, we track these data even for our own sake. Daniel and I, we run a private equity company. We invest in large commercial land deals, and we do a lot. And a lot of the data that we're looking at are even for ourselves. So we count on our own data to be profitable. We're not just spewing these data out just for the sake of saying them, but we actively research this so that we're making better investment decisions ourselves as well, and for our investors.
Absolutely. So if you guys want to continue to be updated, obviously like this video, subscribe to our YouTube channel, and also share this video. One of the things that I love to do to learn and also continue to gauge what's happening in the market is sharing YouTube videos so I can have conversations with my friends who love this stuff as much as I do.
So bottom line, we're not out of the woods yet. Sure, CNBC is saying, oh, we're getting a little bit better. We're seeing a little bit improvements, but it is minuscule in compared to the last 2 years and what we're doing and what I would consider to be normal levels. The correction for this will be, again, more supply. We need more housing. We need more listings. Only then I can see the true housing boom being over. But other than that, I don't see this done quite yet. All we've done is we were going at 200 miles per hour. We're back down to 100 miles per hour. That's all it is. So,
but let me know your guys' thoughts in the comments. I mean, do you think the housing boom is over? Do you think we're slowing down? I mean, what do you think governments are going to intervene and provide, obviously opportunities for Gen Z, borrowers and buyers of the housing market? Let me know your guys' thoughts in the comment section below because we want to hear it.
Absolutely. And the next thing we're tracking, and then this is the next video, so a little, preview for you guys, is that we're now seeing banks bundling and selling default risk mortgage loans to yield-hungry investors, meaning that a lot of these banks are now, again, packaging them into mortgage-backed securities that have risk for default and selling them to, of course, investors, which
happened in 2008, 2007, 2006.
So we'll unpack that story in the next video. So if you guys want to hear about it, we'll get as much data as possible. Here it is. And we'll talk about, is this a repeat of 2006, 2007, where banks are getting greedy again and selling high risk.
Hot potato was risky mortgage bonds. That's exactly what happened.
We'll talk about that and we'll talk about whether this is going to lead to another 2008. So definitely stick around, subscribe, get notified, and we'll see you in the next video.
See you guys.